Today I wanted to go over what a maxed IUL policy looks like. Just because the premiums are the same amount as far as the dollar amount going in, with the same care, with the same insured, same rating, everything's the same, but you'll get to see that there's two totally different outcomes based on just simply the design. I wanted to make sure that number one, you know what to look for when searching for a cash accumulation design policy, as well as some of the questions that you can ask agents regarding how much money you actually have access to within the first year, because typically the IUL gets a bad rap for not being liquid as far as a quote unquote investment sake, even though this is not an investment because this is purely life insurance. Yes, it will perform in my sole judgment. It performs better than majority investments per dollar saved in this account, but that just might be my biased opinion. We're just going to go over the different designs that an insurance agent has capability of when designing a policy, because like I said, the industry in total gets a bad rap as far as policies not being liquid within the first year. Typically you will hear you actually have access to your money after 3, 5, 10, 15 years. I've heard plenty of different stories. And when I actually first began this industry almost 6 years ago, I was taught, I would say, the quote unquote typical IUL design, to where you weren't able to access your funds within the first 1 to 2 years. But thankfully, by coming over to Thrive Wealth Solutions, meeting Rich Dodson, Anthony Chang, Brandon Clark, they were able to show me the proper way to design policies for max cash value growth. And that's what we call here at Thrive the flip design. You may have heard that in reference to some of our posts, as well as that's what we label our specific design as, is the flip design, basically stating with a IUL, your premiums aren't going to be locked in, though we are going to build out your policy based on the comfortable savings amount that you're able to do into the policy, typically over the course of 7 to 10 years. That's how long it normally takes for our design to quote unquote pay for itself, meaning you don't have to save any more money in the policy, but you will want to contribute funds after those time frames, just because the more money you put in here, that's going to be money that's going to help this account grow, and your quote unquote account value is going to be based on the amount of premiums that you put in. So over the course of your lifetime, you're always going to need money to pay for typical life expenses. We want to make sure that you utilize those funds properly by putting them into your custom design policy before you go out and spend them, because what that's going to do is capture the value of those funds before they are gone forever, unless you actually place them into another asset that is going to make you more money as far as leveraging those funds out. This here is the best leveraging tool that I've ever been introduced to. And I want to make sure that before we go ahead and spread the message of how great some of these functions are in the policy, that we also cover some of the downsides, which are that these policies can be designed in a magnitude of different ways. Let's get into what some of these designs will look like when searching the internet. So what we have here are two designs that I just use myself as a case of design. Currently, I am 31, and I put the health rating on both of these as standard non-tobacco, which when applying for insurance, typically I like to break it down in 3 different examples as far as what you can qualify for health-wise. Standard is going to be average health. Most insurance companies are pretty lenient with what they accept as standard as far as current health qualifications here in the United States, because we don't have the best dietary system, and I don't want to get off on a tangent, but they're pretty lenient on what they qualify for standard. The other 2 categories I like to say are above standard, which are typically 2 to 3 different types of above standard ratings. You have select, preferred, and then some type of preferred plus, which is going to be the best in those order going up. And what that is going to do is just help your policy as far as the growth and accumulation. The percentage is going to be better or favored a little bit more in those higher ratings. Now, there is something that is below standard, and typically these are called a table rating that is associated with how bad the health is. So typically it's going to be A is going to be the health rating table that is just under standard all the way till, depending on the company, they go to G and multiple letters below. But as you count down in the alphabet, the health rating is slightly less. What we do to help compensate with those health ratings that are below standard is we just apply for less death benefit. The excess cash is actually going to be growing in comparison to the other ratings that I listed before. If you can get approved for a policy and save some type of money for, like I said, that 7 to 10 year duration, we can come up with a design that'll be in your favor and actually be accumulating cash, as well as you have the living benefits plus the death benefit for your heirs when you do pass away. There is a big value in, number one, getting an IUL policy as soon as possible, because the longer you wait, the more time you don't have for the account to compound in your. So we always are advocates of trying to get approved as soon as you can and not waiting and kicking that can down the line. So we're going to look at this policy here. As we can see, I have a $500,000 death benefit, and the premium outlay is going to be $12,000. Reading this from left to right, you're going to start off. This is just the policy years, and all these values that you see on screen are going to show the specific value at the end of the year's time frame, depending on what line you're looking at. So the first year, I'm age 31. At the end of this policy year, I would have put in $12,000 in premium outlay, and we're not taking out loans in this example, but the net outlay would change if you take out a loan. So in this case, it's just going to be the same. There is two non-guaranteed values as far as interest rates. As you can see here, this first one's going to be a fixed interest rate. All IUL insurances have a allocation to a fixed strategy, which means you're able to put your money into the fixed account, and that's going to spit out a fixed number based on whatever the insurance company is offering. There's not going to be any fluctuation in what you receive for the interest credit. In this case, they're illustrating at 3.5%. But the reason why you do an IUL policy 99% of the time is for the index strategy, hence index universal life. That's what the IUL stands for. They're illustrating based on current economic conditions. They can illustrate this 6.3% interest crediting. And what I want you to notice that we put in $12,000. The cash value is at $9,999, and that's just stating the $12,000 that we put in minus the fees of the policy. This number here is going to be the remainder, and we also reference this column to be our account value. Now, our surrender value, this is most of the time what people want to know. How much money can I actually get out of this policy? So the surrender value is, in this case, 0, based on the $500,000 death benefit amount. This policy, or this illustration here, does have a surrender value, and typically you can spot out if a policy does have a surrender value by looking at the cash value compared to surrender value. If there's a significant difference, that means there is a surrender charge. And all a surrender charge is going to hold on your account for anywhere from 10 to 15 years. Is pretty standard for any insurance company to hold a portion of your money, because let's say in the first year you would have put in $12,000. In this case, for a $500,000 death benefit. And if I was to pass away in year one, number one, their eyebrows would be raised because they probably missed something. Me being deceased within the first year, why I wasn't any hints of natural causes as to why I passed away, and they wouldn't have probably gave me this large of a death benefit. Number one, so there is a 2-year contestability period in not only IUL but all insurance. On top of that, the main point was I would have only put in $12,000, and they would owe my family $500,000. So if they kept this business model and this happened multiple times, this would be a bad business. But they know just based on actuarial tables, people will be living a long time, and that's why they were able to provide the large death benefit based on the pennies on the dollar that you're actually paying for it. What they do to recoup some of those costs up front is to hold, in this case, the difference between this 20,000 and this 8,000. Let's just rough the numbers and say $12,000. And every year that number will actually decrease until, in this policy specifically, until the 10th year. As you can see that in the 10th year here, I would have put in $120,000. We would have made 132 and some change, and the actual value that we have access to is the exact same dollar amount. And death benefit is going to be the same as when we started. This is going to be a level death benefit or option A. Those are one and the same. So I'm just going to scroll down here until the next teaching point, I guess. Let's say right here at age 46 or year 16 of the policy, I would have put in $192,000. Just adding this 108 plus the additional $12,000 in that next year. And based on that $192,000, the account would have grown to $275,743. But I want you to notice here the difference between death benefit from year 15 compared to year 16. In insurance, in order for these accounts to stay tax-free, there has to be some type of death benefit that you pay for. That's just to keep in accordance to IRS guidelines. You have to pay for some type of insurance. If not, this is looked at as an investment, and the growth is taxable. So by the policy growing over the course of the first 16 years, the amount of death benefit that you're actually paying for is going to be the difference between what you have in account value and what you see here in death benefits. So in the year prior, the death benefit stayed flat, but the reason why it's going up is because what's called a corridor. There has to be a specific gap between what you have in your account value and one specific death benefit. So the policy's growing and maturing so well that it's actually forcing the death benefit to do the same. As you can see, year after year, policy is going to grow as far as the cash value, and our death benefit is going to grow. I just wanted to go out to year 30, age 60. I would hope I would be able to retire from this account by then. And typically in a flip design, we can show way less money going in, and you'll be able to pull out plenty of funds just by following our blueprint, aka the flip design. But in this case, I would have put in $360,000, and the account would have grown to just under $930,000. You can see the death benefit has rose to just over $1.4 million there. This is funds that I have access to from year 2. In this case, you can see the surrender value. At any time, I can actually utilize these funds for any emergencies, paying off any bills, or even investing into other assets, which that's what we would want to get to, is actually utilizing this policy first, your primary asset, to go fund a secondary asset where the money is actually captured and will be compounding in this account for you for the remainder of your life before you go utilize the funds elsewhere. So this is just the first design, and this is pretty typical for what you will see when you ask for a max funded policy. based on $12,000. And this is just my current age. You won't see any funds be available within the first year, just because, number one, there was a surrender charge that most of the time agents either don't know how to change, or simply put, they don't want to lower the surrender charge, because what that does is lower their commissions. So the insurance company's never going to be missing out on any money. Best believe that. So as the agent, you're able to either lower the surrender charge and give more equity to the client, or vice versa, keep the surrender charge and give the client less access to their funds within those earlier years. In both designs, you will see both designs, but here at Thrive Wealth Solutions specifically, we like to give you a design policy just as if I was making it for myself. So I would want access to my funds as soon as possible. And that's what we like to do. And I'm going to show you what that looks like here in this next design. So when designing a policy, you can do it one of two ways. And I'm gonna go back to this first design. You can pick a specific death benefit amount and then add your premium based on what the IRS allows you to put into the policy. Or what we like to do, we maximize our policies for cash accumulation. We like to first pick out a specific premium that we're able to comfortably put into a policy, and then reverse engineer and see what is the minimum death benefit that the IRS will allow us to put based on that specific premium that we're looking to contribute into the policy. In this case, at my current age, health, and gender, because males are a little bit more of a risk in the insurance eyes, females get a little bit better leeway as far as how much they're able to be approved for. Based on those factors, age, health, as well as male or female, and then the death benefit size, this is the specific amount that the IRS will allow me to put $12,000 and not a dollar more. Because if I do put in even $1 more, it becomes a taxable event. So this $12,000 here is known as the MEC limit. Your MEC limit is the maximum premium allowed by the IRS in one given year. So that's one way to see how large your policy is built to receive the premiums. Ask your agent, what is the MEC limit of the policy? So exactly the maximum number. And based on that max, if you're not looking to put anywhere in the neighborhood of whatever that max is, that policy is too large. And vice versa, let's say the policy, in this case, the MEC limit was at 6,000, that would be too small, because I'm comfortable with putting in $12,000 in this example. That's a good question for you to ask when looking for cash accumulation, a specific design in an IUL policy. Just like in our previous design, $12,000 is going to be the premium and net outlay. I want you to notice here, there is no surrender charge, and difference between our net outlay and our cash value is going to be strictly just the fees for this specific death benefit amount, 200 and some change in this case. In any IUL, when the premiums go into the policy, the first things that happen is the insurance company will take out the funds for the fees of the policy, and those are going to cover your cost of insurance, your premium charge, or premium expense charge, which is a state guaranteed fund. Each state has a regulation where they will actually take typically 7% of whatever the premium amount is will go to the state guaranteed fund. And all that does is make sure that if your insurance company was to ever go underwater and no longer be in existence, the state would actually pay for those death claims, while another insurance company was to buy out whatever insurance company you previously had that went underwater. That's what the state guaranteed fund is for, to make sure that all contracts are paid out. And then what I want you to notice was, in this specific design, you have full access to your account value. Like I said, cash value, another word for cash value is account value. Another word for surrender value, I like to call it our equity. we have access to at that given year. And as you can see, the same outlay is going to occur here. It is only going to take the first 7 years for this policy to actually meet that corridor and start to raise up the death benefit. And within the first 5 years, you're actually going to see a break growth from what we put in the premium outlay compared to what we actually have in account value. You can see right there, it's a few $100s over what you've actually put in. That's going to continue to happen throughout the lifetime of this policy. The account value is going to compound and increase. I just wanted to point out a few specific points here. In the previous example, we put in 180,000 and the policy grew to $258,884. And in this policy, same time frame, after the 15th year, you can see the policy has grown to 247,722. Just by lowering the death benefit to the bare minimum of what the IRS allows, you can see the policy is going to accumulate cash a little bit quicker, and you'll have access in this design in the first year. Let's go to age 60 or the 30th year of this policy. I would have put in $360,000 into the policy. You can see the policy's cash value has grown to just over $950,000, and as well as the death benefit has grown to just over $1.4 million. I wanted to just show you the power of this account because at any time you can utilize these funds. And let's say at this point in time, for reference, typically what I look for is how much is the money growing year by year, let's say in the retirement age. So from here to here, looks like it's roughly growing, what is that? Right around $70,000 from age 61 to 62. So I know just by this design, you can comfortably start taking out $70,000 from 61 all the way until death, really. And this policy will survive. You will have a annual distribution, or however you would like to take those funds out. But $70,000 would comfortably be able to come out based on how the account is accumulating cash. And not to be confused, but these are just two simple designs. This is not the flip design that we design at Thrive Wealth Solutions. The next design that I show you will be a actual flip design, which the difference between what you see here in a actual flip design is you would utilize your annual income or some bill money, specifically some bill money, to help pad this account in the earlier years specifically, because the more money that we can compound in this account, the more we can leverage your income. So our net outlay of actually the money being saved in the policy would be a same exact dollar amount that you're comfortable with. In this case, I would be comfortable with saving $1,000 a month or $12,000 for the year. We roughly, just off the top of my head, something like $50,000 will be the premium. We would have a difference between the premium and the net outlay would be the loan. So it would be $38,000 in that specific example of $50,000 going in, $38,000 going out via loan to pay for life expense, and $12,000 would remain the same in the flip design. But what that's going to do is we're going to boost up our cash value significantly because we put in $50,000 compared to $12,000, as you see here on screen. And, we'll deep dive into what those numbers could look like. And what I really want to express to you guys today is that, like I said, there can be multiple ways to design the policy. Make sure that if you're working with any agent, whether it be me or anyone else, you ask them, number one, what the MEC limit is going to be from your policy, because that determines the maximum amount of money going into the policy. And based on that number, you can gauge how well that fits your current financial situation. Make sure to ask for the MEC limit. Also, in the policy illustration, look at the surrender charge, or ask your agent, because some insurance companies do label these as different names. Ask them how much equity will you have within the first year, within the first 5 years, or how large is the surrender charge? Because those are all going to be key factors in how much equity you'll have specifically in the earlier years. That's the basic keys that I wanted to go over today. If you have any questions, feel free to get with me or anyone with on the Thrive agency. Y'all have the knowledge of designing policies in a similar fashion. We are here to educate you, number one, on what to look for and how to break down these policies before we actually set anything in stone. Be sure to reach out to us on how we can help you, or even look at current policies that you may have previous to actually hearing from us. So I appreciate you guys for stopping by, and stay tuned because we will be dropping education on a consistent basis on all the social media platforms. Specifically, my handles are going to be Ant Enriquez on all social medias. You can go ahead and follow me. I'll be posting content pretty much weekly and going live weekly as well for the foreseeable future. Alrighty, appreciate it. Have a good night.